And good afternoon. Thanks for joining today's webinar, the 2016 Economic and Ag Markets Outlook. I'm Tom Cosgrove, Senior Vice President of Public Affairs and Knowledge Exchange here at Farm Credit East. We're pleased to be joined today by two leading economists to discuss the current outlook in the general economy and then drill down for the outlook for U.S. agriculture. So let me introduce our presenters. First, speaking about the general economy will be Dr. Michael Goodman. He's an Associate Professor of Public Policy and Executive Director of the Public Policy Center at the University of Massachusetts Dartmouth. Dr. Goodman is past president of the New England Economic Partnership, which produces economic forecasts for the New England states, and co-editor of Mass Benchmarks, the Journal of the Massachusetts Economy, published by the UMass Dartmouth in cooperation with the Federal Reserve Bank of Boston. He has master's and PhD degrees from Boston University. So welcome, Mike. And to discuss the U.S. agriculture outlook, we have Dr. Terry Barr, Senior Director of CoBank's Knowledge Exchange Division. Prior to joining CoBank, Dr. Barr was the Chief Economist for the National Council of Farmer Cooperatives, NCFC. And prior to that, Terry spent 14 years at the U.S. Department of Agriculture, where among other duties, he served as chairman of the World Agricultural Outlook Board. Dr. Barr holds his doctorate from Washington State University. So welcome, Terry. So just to give you the format today, first we're going to hear Dr. Goodman's presentation on the general economy. And then as Heather noted, please type in your questions for the control panel of the GoToWebinar control panel. We'll take a few questions after Dr. Goodman's presentation, and then we'll have Dr. Barr's presentation, and then we'll have a fuller Q&A with both of them at the end. So with that, I'm going to turn it over to Dr. Goodman for his presentation.
Excellent. Thank you very much. It's my pleasure to be here. Just want to show my screen. Hopefully you all can see it. I'm going to offer my thoughts briefly this afternoon on the economic outlook for the United States, highlighting some of the challenges that are in the offing and identifying some of the opportunities that are out there that I think are weighing pretty heavily on our economic outlook. In many respects, where we're at now at the beginning of 2016 is a very uncertain time. As you'll see, on the one hand, we've had very strong economic performance, especially as compared to the rest of the world. On the other hand, we continue to face some pretty significant economic challenges that have made this economic recovery and expansion quite imbalanced across the United States. And obviously, a number of regions, industries, and populations have been left behind. And of course, a number of risk factors on the international scene, which I'm going to try to put in some context for you as we think about what all this means for the national economy in the coming year. The national economy really has been in the midst of an expansion for the last several years. We had a very difficult recessionary period. Obviously, the Great Recession, I think appropriately titled, took a lot of, had a lot of impact on many leading industries and regions of the country, particularly those regions that were more exposed to financial markets on the one hand or housing markets on the other. In the years since the Great Recession, however, we have at the national level recovered all of the jobs that were lost during the extraordinary downturn that was took place in 2008 and through much of 2009, and have steadily been recovering lost output and have exceeded our previous peak on that score as well. What you're looking at here are two different snapshots of key economic indicators at the national level. On the left-hand side, you see the latest forecasts from the Congressional Budget Office, the nonpartisan organization that helps the Congress assess the costs and the benefits of the various policy actions that the federal government is trying to take. You know, they evaluate tax impacts and economic implications and set the assumptions by which the federal budget can be constructed and approved. And I think, as you can see here, the recent history has been one of slower but steady improvement over the last several years. As you can see, and this is an old economic forecaster's trick, the further you get from today's date, the flatter the outlook looks, as we expect more the future to look a lot more like the present the further we get from reality. I do think there are a number of positive signs embedded in these latest forecasts suggesting that we're starting to finally see more broad benefits from the recovery, although not as slowly as we would like. And I do think one of the wild cards here to keep in mind, it has implications for a whole host of different industries, including agriculture, is where interest rates are going to go. There have been a lot of predictions that they're going to rise for some time, and even with the Fed's recent actions, there hasn't been much real evidence of that in the real economy as of yet. On the right-hand side, you can see the sort of regional patterns in economic activity across the nation. This map shows the performance of the various states as estimated by the Federal Reserve Bank of Philadelphia, which prepares its indexes for each of the states. Those indexes track the annualized rate of growth of the individual states across the nation. And as you can see, what we've seen certainly at the end of 2015 and so far in 2016 are some real patterns that are worth highlighting at the national level. Those states that are in red or pink are the states that have been contracting or are growing much more slowly than the nation as a whole. And as you can see, there's some regional patterns here that can be reconciled with some of the patterns we're seeing internationally, particularly when it comes to energy. So states that had been growing very robustly during the run-up in natural gas and oil production in the United States have begun to feel it quite significantly as those investment flows into mining and natural gas and oil extraction have plummeted pretty meteorically in the last few months, and as the demand for oil and natural gas in much of the world slows given the paltry pace of growth at the international level. So states like the Dakotas in Wyoming and Alaska have suffered pretty seriously, as have the states that are involved heavily in those sectors on the Gulf Coast as well. Significantly, the parts of the country that have been growing more rapidly are those that are strongly positioned in what we call here in New England the innovation economy, or those knowledge-intensive sectors that have continued to create and add value, create lots of wealth, and to drive growth. I think that kind of trend, the shift away from production and towards services, particularly value-added services, is not new. It's something that's been playing itself out over generations. But I think in the period since the Great Recession and through this expansion to date, we've seen the growing returns to those kinds of technologically based economic development strategies. And I think those states that have are not well positioned there, do not have the kind of workforce and the kind of institutional infrastructure to play successfully in that world, have struggled and have relied heavily on their natural resources, which when times are good serve them well, but when times are not so good, particularly right now, are a profound competitive disadvantage. All of that growth, however, even as imbalanced as it has been, and as and more slow growth trajectory than we would like, has led to a pretty consistent recovery in the national labor market. So we still have significant problems that I'll discuss when it comes to the job market here in the United States. Mileage varies pretty significantly by region, by industry sector, and by demographic category. But I think we're in a very extended period of job creation, almost all of which has been in the private side of the economy. We just experienced our 71st straight month of net positive job growth. And during that period, since the worst of the Great Recession ended, we've added about 14 million jobs. So we have fully recovered on the labor market side, even though it doesn't always feel that way to certain segments of the population, certain regions of the country, in certain occupational classifications. But it's quite an impressive rate of job growth in light of what we've experienced in recent years. One of the things that's been very concerning to many, and I think has helped keep pressure on inflation and on interest rates, has been the failure really to see much sustainable evidence of wage growth in the economy. So we're still working off a lot of imbalances in the labor market. There were many people who dropped out of the labor market during the worst of the recession and since, people who've been unemployed for extended periods of time. And even though we've started to see an uptick in voluntary separations from work, that is people quitting and taking new jobs for higher pay, presumably, after not receiving raises for an extended period of time, that hasn't quite taken off yet. And I think that's one of those mysteries that that economists have been tracking, trying to figure out why we can have this kind of sustained labor market expansion without the associated wage growth. I think technology is playing a role, as I'll discuss a bit later, and certainly so is international competition. Although the most recent evidence in this regard, as you can see in this chart, is encouraging. In the last couple of national jobs reports, we've started to see an uptick in average hourly earnings for workers in the private sector, even as inflation starts to move upwards but remains very low by historical standards. So this has been a recipe for real wage growth of late for many American workers who have not seen real wage increases to their household bottom line in many years, in some cases in decades. I think there is a boost as well that's not contained in these data that is putting some wind in the sails of the American consumer, and that is the lower gas and prices at the pump. And for those homes and businesses that are living in areas of the country that rely on heating oil like we do here in the Northeast, it certainly put some cash in their pocket, money they didn't have to spend at the gas pump or to the oil company or to the utility that provides them with the fuel they need to heat their homes and to power their businesses. And so I think after a long period of wage stagnation, we're finally starting to see some signs of life, which is very encouraging. If that continues, I think the message that policymakers at the Federal Reserve Board have been issuing makes it clear that they'll try to keep pace with those increases by slowly but steadily increasing the interbank rate of interest that they have some control over. They have made one move. It hasn't had much real visible impact on commercial real interest rates as of yet, but I think it's an encouraging sign that bears monitoring. All that said, I think you'd have to be Pollyanna not to see in the national labor market some significant stresses and strains and real challenges. If you take a look at the most broad definition of unemployment in the United States, that is the that is the so-called U6 rate. This includes everyone who's unemployed, everyone who's dropped out of the workforce but would like a job, and those who are working part-time when they would rather be working full-time. That is, they're involuntarily part-time for economic reasons. Even though, as you can see in this chart, conditions in that group have improved steadily since the end of the Great Recession in 2009, we're still looking at about 10% of the labor force in a situation where they're either given up looking because they don't believe there are jobs out there even though they want one, or working part-time hours when they rather would be working full-time hours. I think it's important to keep in mind that the vast majority of the jobs that have been created in the United States have been full-time jobs, but there's a segment of the population that's pretty sizable that has not been able to access those job opportunities, and I think there are a couple of reasons for that. One is what we have some evidence of is what economists call hysteresis. I'll unpack that. That is structural change in the labor market where someone who's been out of work for an extended period of time, several years in many cases, has a very difficult time getting back into the labor market because that gap on their resume is interpreted by potential employers as a signal that they're really not, that there's something wrong there and they should be avoided. It's still a buyer's market for employers in the labor market, and there's some clear evidence from experiments that are coming out of places like Northeastern University here in the Boston area that suggest that employers are discounting the skills of people who've been out of the labor market for an extended period of time. Also, I do think that even though the tide has been rising in the national labor market, it has not been lifting all boats. If you're younger, especially if you're poorly educated with limited skills, you're having a real tough time in the labor market. Interestingly enough, younger people who have better skills, that is technical skills that they can demonstrate through some sort of certification or labor market experience, or college degrees, whether at the community college level or at the 4-year and beyond level, have been doing relatively well, even if they're not always working in jobs that are taking full advantage of those skills. So I think the real losers in this labor market continue to be younger, more poorly educated, minority participants in the labor force, and folks who've been out of work for an extended period of time. Conditions, again, slowly seem to be getting better for those folks, but I think there's been a big disconnect and a big imbalance in the nature of the labor market recovery that I think is worth keeping in mind. It keeps those people out of the workforce, which is a problem for us as we age as a population, and I think what's long been a social challenge, reconnecting folks to the world of work, is increasingly becoming an economic challenge, and will worsen if the recovery continues at its current pace. Part of the challenge in the labor market has been a bifurcation or a dual labor market that's emerged over the last couple of decades. This chart shows where jobs have been created, breaking it out by occupation and wage over the last few decades. And as you can see, those blue bars are showing job growth, the orange job decline. What we've seen is a shift in the demand for labor at the low end, which has risen substantially, a very low level of service jobs. These include things like home health aides, personal attendants, all kinds of allied health occupations, many of which pay at or around the minimum wage. They don't require advanced levels of training and skill, just personal engagement and some personal commitment and a basic level of skill. And at the high end, much more high value-added jobs that require lots of embedded knowledge and technical skill. So information technology jobs, advanced engineering activities, consultancies, professional and business services and the like, educational professionals, et cetera. Those folks are in demand in many parts of the country. What's been left behind, and I think a lot of this has to do with globalization and technological change and what some economists have called skill-biased technological change, has been a hollowing out of the occupational distribution in the United States, where folks in the middle, folks who had a moderate level of technical skill, the major blue-collar occupations that were at one point in our past paying middle class or better wages, have essentially declined due to global competition, automation, and other technological innovation. And this has created problems. Now, we do find ourselves within some of those occupational spaces in many parts of the country with some niche skill shortages. So even though you see machine operators as one of the larger declining occupational groupings here, if you talk to regional manufacturers, particularly small and medium-sized manufacturers, they're finding themselves, as their workforce ages and retires, in need of some of these folks with these skills, many of whom have left the labor market, retired, or switched careers. And so this transition continues, but I think one of the challenges facing the United States and facing those of us who are concerned about our economic future is how you make a place for middle-income wage-paying opportunities that don't necessarily require advanced degrees, high levels of education and training, and related experiences. But I do think there is a lot of good news here, but I think the hollowing out of the middle income job market has been, or some call it middle skills, has been a big challenge both nationally and in many regions of the state, particularly in the nation, excuse me, particularly in those areas of the country that aren't home to high proportions of college-educated and beyond residents. On the other hand, the regions that are home to those kinds of workers and the kind of institutions that help to spark innovation have been outperforming the nation and succeeding quite nicely. But the imbalance, I think, is a big part of the story here and helps to explain some of the frustration we see out in the wider world, including in our political discourse. One of the other things that I think is worth highlighting about the labor market before I turn to some other indicators is the change that we're experiencing in the way that our population relates to work. We're going through a giant demographic transition here in the United States, as are the other developed countries in the world. Our baby boom population is now moving into the prime retirement years, and over the last decade or so, we've seen a steady decline in the rate at which people who are of traditional working age are participating in the workforce. This chart nicely breaks out some of the explanations for that, looking at some recent data and an analysis that the Council of Economic Advisors prepared. This is a very similar analysis to some that are being done by the various Federal Reserve banks and academic economists. And it looks like we've got a couple of different things going on that are worth keeping in mind that are reducing the rate at which our workforce is participating in the labor market. A big part of it is structural. So as we age, we have a tendency to get sick or disabled and drop out of the workforce for those kinds of health-related reasons. We also, at least most of us, aspire to retiring or stopping work at some point. And so as the composition of our population skews older, we can expect to see more of those age-related departures from the labor market. And that's certainly what we have been seeing, and it's estimated here to be a big part of the explanation for declining labor force participation in the United States. The other thing I would highlight is that we had a big run-up post-World War II in the rate at which women participated in the workforce, and that seems to have plateaued about 15 or 20 years ago, and has been steadily declining since. There are a lot of competing explanations for why that's happening. Certainly stagnant wage growth and the high cost of things like childcare and preschool education are both factors that some analysts have identified as reasons why women might not be as attracted to the workforce now as they once were. So there's a big part of this story is structural. The other, I think, is cyclical, and there are some debate about this, but I do think that there is a strong argument to be made and some evidence to support it that we're still kind of recovering from the hangover, if you will, associated with the Great Recession. And the impact of that, as I discussed a few moments ago, on many of our workers who've been out of work for an extended period of time and at the lower end of the skills spectrum, urban workers, minority workers, and the like, have led to, I think, some changes in the way that people connect to the labor force, discouragement in many cases, and frankly, a disconnection that I think it will take more and better job opportunities to bring people out of those marginal places and back into the labor market. But I think it's important to keep in mind, because you hear a lot about this, that there are both structural and cyclical components, and I think both are amenable to policy. All of these changes that I'm discussing are taking place in the context of what's been a very slow-growing in a historical sense, and an increasingly volatile global economy. There are a number of different things that are going on that in the last several years have led to a growing adjustment of our expectations about future growth here in the United States downward. We do rely very heavily on trade with the rest of the world to drive our growth. We certainly are an extraordinarily large and dynamic consumer economy. Some of the developments that I mentioned earlier around job growth, job security, and the very beginning signs of wage growth, along with low interest rates, have fueled a lot of economic activity among the consumer that's positively affected those consumer durable goods industries, like the auto industry in particular, and has put more discretionary income in the pockets of consumers. But for our exporters, it's been a different story. During this period, the last few years, the better performance of the United States, even though it's not always great, has, among other things, has put upward pressure on the value of the dollar. And a strong dollar is a good thing, but it makes our goods more expensive when it comes to global trading competition, and so that's been an issue. I think the other thing that's happening globally that certainly is being felt indirectly here, and more directly in other parts of the world, is what's going on in China. I think it's hard to have a very systematic assessment of what's going on in China. It's a nation that isn't exactly transparent in terms of how it reports its economic data, but there's no question that if you triangulate the available information, you look at activity rather than government reports, there's a pretty significant slowdown going on there as they go through what I believe is a necessary but very painful transition from an economy that's been primarily dependent on manufacturing, production, and exports to one that looks more like ours, frankly, that is a balance of manufacturing and export-driven activity and a consumer market where demand by the residents of the nation are driving economic activity domestically. And as you can see here, here's the chart on your left, is, I think, a useful illustration put together by the Financial Times of the shift in economic activity that's going on in China from industrial production to services. Now, this is painful there because it's harder for the government to control. It puts more decision-making and autonomy in the hands of the people, and that can be politically scary for central governments like China that wish to control everything from the corner office. But it also has real implications for the rest of the world, particularly the resource-dependent economies around the world, those that produce commodities, particularly oil, natural gas, and all of the various natural resource inputs into the manufacturing sector. And so as China has slowed and it has shifted its emphasis and started expanding in different areas, those nations that have relied on China as a destination for their natural resources, oil-producing nations in particular, but other commodity producers as well, have really seen a reversal of fortune as the demand for those commodities has dropped off and the price has plummeted very dramatically. So the other thing that's going on in China that, again, is not entirely transparent has to do with credit. The government has been encouraging individuals and corporations and regional and municipal governments to make very, very large investments in infrastructure and housing and commercial development. And even though there's not a very clear view of how that's working out, it is pretty clear that there's a giant amount of overdevelopment. The way that they rode out the Great Recession was by spending themselves into hopefully not oblivion, but certainly into a situation where they've got a substantial debt overhang, both at the government level and at the consumer and business level. So that also bears watching, but it's certainly something that is already having implications for economic performance and the outlook for many other nations, particularly those natural resource-dependent economies who also happen to be very politically volatile in many cases, and with negative implications for global growth. So that all of these discussions are happening in the context of a developed nation and an emerging nations that are, I think, operating in a very uncertain period. All of this, I think, has been a recipe for a lot of caution in global markets. This is a very useful chart from the New York Times recently showing, it's a little dated now, about a couple weeks off, but you can see 2016 has started off with a lot of nervous investors trying to figure out where to park their money. So you can see that moving out of riskier investments, distancing themselves from China, racing away from commodities and other kinds of volatile assets has been something that has been the order of the day for much of this new year. I think the other factor, in addition to the a renewed, what some have called flight to safety, where am I going to stick my money? It helps to keep interest rates low. You've got negative interest rates now in Japan, meaning that the government will essentially pay you a premium to borrow money, something that I think some of us thought might be theoretically impossible. It's happened. Our interest rates remain very low despite the Fed's efforts to start to slowly increase them. And capital now, even in a governmental context where there's a lot of central control, is finding its way out of these struggling places and into what are perceived to be more safe havens. So if you take a look at this chart on the right, you can see money is flowing out of these emerging markets, including China and Russia in the Middle East and into what they consider to be safe investments, not just U.S. Treasury bonds, but U.S. real estate in London. Here in the Boston area, if you were here, you would see cranes all along our skyline as luxury apartment buildings and condominiums. Average rent $4,000 a month for a two-bedroom are being built and pre-sold in many cases to international investors. So that money is flowing out of these challenged places and into more established and currently considered to be secure investments in real property and real assets in the United States. And that has real implications for the economic and financial stability of these places. I think China in particular has developed a very sizable and rapidly growing upper class or high income population, and those folks, I think, are sensibly hedging their bets by not keeping all of their money in the homeland and starting to spread it out across the world. So the globalization is playing itself out in a way that I think currently is a bit destabilizing for many emerging economies, and certainly to the benefit of some of the more established economies. How long this can last is a real good question, and obviously changes in the way that global trade has developed and the way that investment is flowing around the country and around the world are bearing on this as well. But it has been a rough ride of late, and I think that's expected to continue in the near term. Just another way of illustrating how these global commodity prices are changing. I mean, this has been a fairly dramatic downturn, and it's not just energy. It's also all the precious and raw materials that are used as inputs when global trade slows, when production slows, when demand is off in many parts of the world. The need for these inputs correspondingly falls, and not surprisingly, so does their price. Oil, I think, is the one that most of us have been paying most close attention to. We've gotten to the point in the United States where in much of the country, the break-even cost of producing a barrel of oil or a unit of natural gas is above what the retail price would be. And so that's a recipe for reduced production, which helps to explain some of those regional declines that I discussed at the onset of my remarks. One of the factoids I saw recently that struck me quite profoundly, if you look to the left, the barrel that we keep the oil in is now significantly more expensive than the oil that's in it. That's been the case for a while. Now it's a fraction of the cost. I think that's revealing. I don't know that this can continue for an extended period of time, but it's certainly something that is having a real impact on those natural resource-dependent economies. And as I'll discuss later, those are some of the more unstable nations and sort of geopolitically volatile nations in the world, which makes everything a bit more complicated. Here in the United States, all of these factors that we've been discussing have been shifting where investment dollars are flowing in the national economy, continuing a trend that's been in place for a considerable period of time towards moving away from investments in traditional hard assets, bricks and mortar facilities and equipment, and more investment flowing into what you might call intellectual property and innovation and knowledge-intensive activities. You can see on the upper left here the investment in mining and natural fuel extraction. The money being spent on shafts and wells and associated equipment has plummeted as that market has softened dramatically. Whereas if you look at the bottom, investments in research and development and technology and software continue to rise pretty substantially. And so when you think about where the money is flowing in this economy and what that means downstream for things like jobs and income creation, it helps to provide somewhat of an explanation for why job creation has been shifting in the manner that it has, and why the beneficiaries of a lot of these investments are disproportionately folks who are occupying professions, engineers, technologists, computer scientists, academics, lawyers, consultants, etc. And the kind of bricks and mortar investment that drives expansion in more labor-intensive and blue-collar sectors of the economy has waned somewhat. So if anything, current conditions are reinforcing these trends that have been playing themselves out over the last generation or two here in the U.S. and are beginning to be in evidence in other parts of the world. I know there's a great interest in the housing market, so a lot of these imbalances, I think, are having implications for the way in which young people form households, the prosperity, particularly in areas of the country where the housing market has been, over time increasing pretty substantially, has left some retirees with a considerable amount of home equity in those parts of the country that have recovered fully from the housing downturn of, say, 2005-6 to 2010 or 11. The upper left-hand chart here, the estimated household formation one, comes from the Turner Center at University of California, and I think it helps to explain what's been going on in the national housing market. Normally what happens typically is, people form households when they leave the parental home, if they leave the parental home, and then at older ages they may shift their housing arrangements and move from the home they'd spent their life in or raise their family in to different kinds of housing units. Recently we've been seeing one half of that story and not the other. We've been seeing very limited new household formation at the younger age cohorts. And that's significant because it drives demand for new housing units and has a lot of implications for construction activity and production of new housing. What we've been seeing, rather, is a significant increase in household formation, new household formation at the higher end of the age distribution in the retirement years. Number one fastest growing household size in the United States is 1, right? So this has implications. So if most of the new households are being formed among the elderly population and the household sizes in that segment are getting smaller, then that's a recipe for more multifamily housing, more housing with different kinds of unit options, and more rental units as opposed to home ownership units. And that's exactly what we've been seeing in the housing market. You can look at the starts, you can look at and volumes, and what we're seeing in the parts of the country that are adding new housing stock is fewer than typical new single-family housing starts and actual constructed units, and many more multifamily housing starts than we would expect during a typical recovery and expansion period. Again, I think that's responding to demand. I often get the question, are young people not forming households because they don't want to, or they don't want to own homes, or because they can't? And I think the answer to that question is yes. I think there's a bit of both going on. On the one hand, the barrier to entry into the housing market involved in tighter credit standards and higher down payment expectations and more established credit histories make it difficult for younger people to make their way into the housing market in a way that their parents or grandparents did. But also I do think habits and preferences have changed. There does appear to be a preference among the the younger millennials in particular for smaller housing units, for units next to transit, and for and less attraction to cars and commutes and larger properties. Now, when the $64 billion question is, when those young people get to the point where they want to settle down and raise families, are they going to all suddenly want to move to the suburbs, live in single-family homes, and own 2 or 3 cars? I don't know. I suspect that that there will be more than a little bit of that going on. So the debate continues as to whether or not this is a fundamental shift in housing preferences or just a response to what has been in recent years, up until quite recently, a tough job market for young people, stagnant wages, and tighter credit standards. Overall, I think we would normally expect more production on the housing side, more of a market response to housing. But a big problem is that the imbalanced growth patterns that we've seen have made certain regions of the country incredibly attractive. There's been migration to those regions, but not a market response in terms of the construction of new housing. If you think about the greater Boston area here or the metro San Francisco region, for example, it's very difficult to build new housing in these areas. And to the extent that we can't build enough housing to respond to demand, it's been a recipe for an increase in prices and difficulty when it comes to affordability. In the vast middle of the country, I think mileage varies pretty significantly, but I think production activity overall there remains below what we would expect normally, and prices in many regions and many regional markets have been slow to fully recover, whereas in these hot markets that I mentioned, there's a lot of demand, but an inadequate level of supply. The other wild card that I'd like to bring to your attention that is beginning to get more and more attention is the changing relationship between investment in certain kinds of enterprises and the kind of real economic returns in the broader world that we historically expect to see. One illustration of that can be seen in this chart, which compares the staffing levels of the two of the largest most highly valued corporate entities in the United States, Amazon.com and Walmart. They're both realtors. I'm not making any value judgments here, but one of them employs 2 million Americans and one of them does not. And Amazon, I think recently now has a higher market capitalization than Walmart does. So if we think about this for a minute, right, if Amazon is worth what the market estimates as $250 billion, $250 billion, and it can be worth that much money by employing a relatively small number of people, it's a troubling signal that the standard relationship between investment and production and employment and income isn't always going to be in evidence in a new technologically driven world. Larry Summers, the former president of Harvard and an eminent economist, has talked about the sale of a company called WhatsApp, which some of you may know is a social media application that allows people to connect with one another and do like FaceTime style video chatting on Wi-Fi. So it's been very popular, particularly outside the United States. That firm was sold to I think it was Facebook for $18 or $19 billion, and only had several hundred people attached to it. So we're used to seeing an $18 billion enterprise and seeing hundreds of thousands, if not more, employees, multiple facilities, real estate investments in equipment, technology. They're hiring lawyers and consultants and all of that. A lot of that is still going on, but the labor-intensive part of it is not always in evidence, particularly in these technology spaces. So as our economy becomes more embedded and dependent upon these kind of technology-fueled patterns of economic development, it's important to keep in mind that the jobs don't always follow, even though those enterprises are undeniably major contributors to the national economy. It creates what we call a distribution problem. And so I think that's something that is going to be getting more and more attention by U.S. policymakers and, frankly, international policymakers going forward. But it does suggest that it's going to be tough to manage, and that some of these trends that I've been talking about that are leading to more imbalanced patterns of growth may likely continue or worsen if these trends continue as they have. I want to close by highlighting some of the fundamental headwinds and uncertainty that surrounds our economic outlook. I think the U.S. is as well positioned as any nation in the world to ride out whatever comes next. But I do think there's a considerable amount of geopolitical uncertainty in the world, as I'm sure surprises none of you. And I think the patterns and the slowing of world trade and the changes, particularly in energy markets, if anything, make those situations more volatile. This shows some survey data maps to the globe on what the top concerns are of various nations. And you can see here a laundry list of sort of wild cards for the near term and the medium term future of the nation and the globe. Climate change and sea level rise in particular, major concerns as you can see, in Asia and South Asia and South America and at least Mexico. Here we're concerned more about global terrorism and ISIS, at least that's the top concern according to the recent surveys. And then economic stability and assertiveness in Eastern Europe in particular, as well as ongoing conflicts and concerns and instability and important but a bit scary political transitions in places like China and Iran, I think represent real wild cards. But fundamentally, I think the U.S. has been disproportionately benefiting from some of these patterns. I don't think we are where we need to be in terms of our economic performance, but in light of all of these uncertainties, I think we're reasonably well positioned to ride out whatever confronts us over the next year or two. And my best assessment, based on the information that we have today, is that 2016 will look a bit like 2015, with most of the risks skewed to the downside. And with that, I'd be happy to stop and take some of your questions.
Great, thanks, Mike. So I think a slight change of plans. We did get a question that came in about China, but I know Terry's going to talk a little bit about China as well. And since we're about halfway through the webinar, I think I'm going to hold that one to the end, let you both take a shot at that one. And so I think at this point then, I'll turn it over to Dr. Barr for his presentation. And I know Heather's getting that set up. Terry, we see your screen. Got to unmute. Okay.
Are we there?
Yep, go ahead, Terry. It's all yours.
All right. Thank you, Tom. Appreciate the opportunity, and I am going to take a kind of a quick look at where ag's at this point in time. I think you've got very good coverage with regard to the U.S. economy and the global economy, and I think the real important thing, I think, for ag is to kind of recognize that where we are in terms of the transition of the commodity cycle. This is not something new to ag. If you go back to the early 70s, we've been through these transition in commodity prices. This slide is just an index of agricultural prices and energy prices, and a good reminder that we do get these big transitions or super cycles in commodities that move the price levels up, and then we stay in kind of a normal zone, if you will. Still a lot of volatility, but it's a volatility driven more by cyclical type of events, such as crop shortfalls or surges in demand that kind of outstrip supply in the short term. And you can see, from the early 70s to about 2004, we had kind of that old normal zone where we saw that volatility in U.S. agricultural prices. The energy side is a little different in the sense that it can be driven by events in the Middle East in terms of wars and other disruptions and so forth. But again, you can see that we were in a pretty relatively stable period for 30 years until we get to kind of that 04-08 period where China and the rising middle class and the global economy really drove all commodity prices significantly higher until we get to Lehman Brothers in 2008, and then you see that sharp decline in really all the commodity prices. But both energy and ag kind of weathered that 1 year downturn in the global economy, largely because China, at least from that 09 to 012 period, was still growing at almost double-digit rates. So China was kind of carrying the economy while the rest of the advanced economies tried to deal with the financial meltdown. But of course, more recently, was alluded to, Chinese growth rates have slowed. They are making their transition to a lower growth rates. Their targets have been lowered to the 6 to 7% range. Anti-corruption campaigns have kind of solidified political leadership. and now we're watching that economic transition from being investment and export-led to being more consumer-led. That obviously is going to take some time, but we're in a different time period with regard to China. That's pretty fundamental to the commodity side because they were driving this commodity side for a long period of time. And now the question is kind of where is that new normal zone for, particularly for ag commodities? I think it's clear that the energy side is probably overshot at this point with that large increased availability of oil reserves weighing on the market in the midst of this weak demand. And on the ag side, what we're seeing is the weak demand really is allowing some buildup in commodity inventory. So all of the factors that really has driven agriculture over the last decade, if you look at them carefully, and I think has already been alluded to, most of these things have reversed direction at this point in time. Obviously, China is much slower growth, much more volatile growth. The value of the dollar is sharply higher. The advanced economies really are all facing subdued growth potential because of the structural problems that they have to deal with, largely a result of large debt loads and aging populations and lack of any kind of political leadership or consensus on how to do that going forward. That's going to leave these advanced economies in kind of a subdued growth potential, I think, for the foreseeable future. As was mentioned, nobody wants to put money in the emerging markets. You have Brazil in the second year of a major recession, and virtually all of the emerging markets really are much more subdued growth paths at this point in time. That's edging on commodity demand as well in the short term and probably well into 2017. As was mentioned, global terrorism, geopolitical risks, we've almost gotten used to that one as being a factor in the market. The markets don't react as violently as they used to events in that arena, but certainly they continue to be a driver, particularly in the Middle East where you have issues relative to energy as well as geopolitics. So we are beginning to see these commodity supplies grow, and I think when you're looking at it in the short term, over the next year or so, unless Mother Nature intervenes, we're probably going to stay in this bottoming phase of the commodity cycle. There's really nothing on the horizon. I think you can see from these previous comments, there's really nothing on the horizon that suggests we're going to have this big breakout on the demand side. That really is the supply side now that's going to drive these markets in the short term until we get some of these issues resolved, either in the advanced economies or China completes its transition. There's really no real reason to believe that we're going to have a breakout of the demand side, that it's the supply side that we're going to be watching. We're still going to have opportunities, I think, in agriculture in terms of pricing. But as I said, they'll probably come from supply side more so than demand side over the next year or so. The other important point to remember for agriculture is after that decade of growth, we now find an agriculture that's much more export dependent than it was even a decade ago. We've always had a significant dependence with regard to the grains complex, but from this slide you can see, what percentage of these commodities we export, who are our major players, how concentrated it is, and I've highlighted, of course, the red area being the Asian markets, which is kind of where the new growth area is going to be. Canada and Mexico will always have high positions in most of our trade, particularly on the animal protein and dairy side, but the growth areas are really in the Asian side, and you can see there are some other parts of the world, but by and large, Asia drives an awful lot of this growth. A couple of interesting things here. You'll notice corn only has a 13% of production going into the export market. That really was a factor in terms of ethanol being the big capture of domestic corn use for a long period of time. Now that that ethanol demand really has kind of leveled off, we really need to get back into the export market pretty aggressively, and I'll talk about that in a little bit. On the meat side, you can see we're now exporting 23% of the pork in this country. We've always exported about 20% of our poultry, but the rise in terms of export demand for pork has been phenomenal over the last 10 years, and now that's very much a export-dependent sector. And of course, as many of you will know in your part of the country, the dairy industry has become much more export sensitive. When I talk to dairy groups, over the last year or so. I spend more time talking about the European Union, New Zealand, Australia than I do about the domestic side. It used to be when we had these discussions, we talk about Midwest dairy versus California dairy. Now we're very focused with regard to the emergence of what's going on in Europe with the elimination of their quotas. What kind of demand have we got coming out of the Asian markets? So it's a different marketplace for dairy, and I think in general ag finds itself in these debates much more so than they have previously. And I think what it says is that business strategies kind of have to adapt to that. They have to adapt their risk profile. I think they have to look very carefully in terms of their marketing strategies. The things that seem to work pretty well over the last decade probably are not going to work nearly as well when you get into a marketplace dominated by supply side adjustments as opposed to demand side going forward. And so we're going to see a lot of transitions, I think, in ag over the next few years, both domestically and globally. Deals like the China acquisition of Syngenta and so forth tell you something about how the global market's going to evolve, and I think we're going to see that evolution play out in the domestic side. In general, we're just seeing a significant transitions across all the commodities. When you look at grains, global grain inventories are building. This slide just shows you grain stocks, wheat and coarse grains. You can see that over the last 3 years, we've been consistently building global grain inventories. Now, the stocks to use number, that's how much inventory do we have relative to our use. We're not back up to those high levels we saw in the late 90s and so forth. So we were seeing demand side still grow relative to these inventories, but we are beginning to build a level at which will mute some of the price response to some of the volatility in terms of the supply side. And I think that's a change from where we were just a couple of years ago, where we did not really have those inventories to kind of buffer some of the developments going on. The export markets have rolled over, particularly on the grain side. As you can see, the coarse grain market has dropped off fairly significantly, along with the wheat side. World trade in soybeans has really been supported largely by China. 63% of the trade in soybeans goes to China. So as long as we keep buying, that export market or trade flows in soybeans is probably going to stay up there. But it is a one-country commodity at this point in time, and that bears a lot of watching in terms of adjustments that might be coming down the road. The cotton side, of course, has dropped off fairly significantly, in large part because China has built such large inventories on the cotton side. So the export markets really are waffling a bit, with the exception of China and their soybean demand. And a large part of that impact on the U.S. is when we see that softening in global trade, that's when we begin to see currency changes have bigger and bigger impacts. And I think in general, I don't focus a lot on the currency movements as long as they're kind of in that 1 to 5% range, but these are very significant changes in currencies. They have big impacts on our customers as well as our competitors. The decline in the dollar was a big factor in the 04 through 2012 period. You can see the dollar fell in value by almost 40%. That really means for a lot of our customers, we could raise the price of our goods by 40% and our customers wouldn't see any price increase. That really gave us a very competitive edge going forward. Now we see the dollar rising very significantly, particularly since about the middle of 2014. So over the last year and a half, we've seen very sharp increases in the U.S. dollar. We're up about 40% from the bottom. It's actually up about 4 or 5% really just since October. It's backed off a little bit here recently, but you can see the kind of currency movements that are out there relative to a year ago, relative to 2 years ago in terms of the dollar. And you'll see things like Russia, whose currency has fallen by 128%. Now, that does not mean that they have a negative currency. It really just says whatever they could buy for 30 rubles in 2013, they now have to pay in excess of 60 rubles for the same product. So massive change with regard to Russia, but equally important when you look across some of our customers and our competitors. When you look at Brazil, for example, their currency has fallen by 70%. These are big swings in currencies. They have big impacts that last a long time, in terms of transitions of our competitors and our customers. One way to look at that is just to look at the price of corn in terms of these local currencies and versus the U.S. dollar. If you did that from January of a year ago, U.S. corn prices are down 3.4%. Brazilian reals and local currencies, corn prices are up 42%. And in Mexico and the peso, for Mexican consumers, these corn prices are up about 13%. So this is not a prediction of what prices are actually at those levels in those countries. This is simply just a currency adjustment. But what it says is there's a lot of incentive in local currencies for Brazil, for example, to expand corn and soybean production, and Mexico, some of our big customers, even in the Asian regions and so forth, are looking at price increases on commodities despite the fact the U.S. consumer or U.S. producer is not seeing those prices. So again, I think these are going to have lasting effects in terms of U.S. competitiveness going forward. The other piece of the puzzle, I think, for the commodity side, particularly the grains complex, is to remember that the rest of the world has expanded their grain production pretty dramatically over the last 7 or 8 years. Non-U.S. grain production's up about 22%. U.S. grain production's only up 4%. And a lot of this has to do with the fact that we've diverted acreage into oilseeds in response to the soybean demand, and also that we've diverted a lot of our corn into the ethanol industry. So while we were diverting that corn production into ethanol, the rest of the world was expanding their production to satisfy global demand for commodities, particularly coarse grains. So now when we turn our attention to the current environment, we find ourselves in a very competitive position relative to other producers of grain at this point in time. When you throw in the strong dollar, we really have some challenges in terms of gaining export share back, and I'll talk a little bit about that as we go forward. In general, when you look across the commodities, wheat, of course, is the one where we are beginning to see sizable increases. I think USDA is releasing some numbers today. I think they will indicate that these global wheat numbers are probably even bigger than this, that we are starting to move this stock-to-use number back into the zone that we saw in the late 90s and early 2000s. So I think here's where you've got the most pressure because of large wheat supplies. And again, we're not feeding as much wheat because we have larger coarse grain supplies as well. So I think this wheat market is probably going to be under the most pressure going forward. But the reality is the wheat's produced everywhere in the world, but there's a lot of volatility in wheat production. So I think there will be some pricing opportunities. If you look at a country like the former Soviet Union, the 12 countries that make up the former Soviet Union in this slide, that's about 26% of world trade in wheat. But notice that red line has a lot of volatility on it. So, you know, their wheat production is highly variable. They've had a couple of good years over the last couple of years, but you can see that historically a lot of volatility in that one. In the U.S., we're cutting wheat acres. We do have some areas that are not coming through the winter season very well. So I think we will see some pricing opportunities in the wheat side. But again, they're not going to be pricing opportunities that long-lived, because they're really driven by the supply side much more so than kind of a significant shift on the demand side. When we look at corn, again, we're maintaining fairly large inventories on corn, not historically large, but certainly larger than what we saw over the last 3 or 4 years. And that's really kind of taken the edge out of the market to some degree. Obviously, large wheat supplies also keep pressure on the market. But the big challenge for the corn side and for the coarse grain side really is finding a substitute for that ethanol demand. You can see from this slide on the usage of corn, you can see from 2004 to 2010 or 11, the ethanol demand was going up very sharply. We were going from less than 1 billion bushels to almost 5 billion bushels used in the ethanol complex. That really meant that there wasn't corn really available to put into the export market. And you can see from that blue line, our exports, which had reached almost 2.5 billion bushels, really declined to under 1 billion bushels. We recovered a little bit of that, but we now find ourselves in a real struggle to grow that export market, to find a new demand side. to drive the price of corn against available supplies. And you'll see from the box at the top there, our exports declined 3% in 2014, projected to decline 9% in the current crop year. So the corn side really has a challenge here in terms of growing that export market if they're going to match up with the kind of acreages that they're currently deploying given yield increases. This slide illustrates a little bit of what I was talking about in terms of competition. In 2005, the U.S. had 56% of the coarse grain market. So 56% of the trade in coarse grains globally belonged to the U.S. We entered into that phase of that transition of diverting our corn supplies into ethanol, and you can see that Brazil and the former Soviet Union really began to expand their grain production. They now hold about 32% of the market. We hold about 32% of the market, and certainly we're going to have competitive challenges in terms of trying to grow that export market as we go forward against the backdrop of kind of a weak demand and a strong currency in terms of gaining access or recovering market share that we need if we're going to keep deploying this much acreage in the corn complex. On the soybean side, it's really about ourselves in South America. Again, it looks like we're going to have another world crop or near record world crop this year, second in a row, recovering production in both the U.S. and Brazil and Argentina really mean more than adequate supplies of soybeans to the global marketplace. You can see from this slide that those stocks have risen very sharply over the last 2 or 3 years, approaching somewhere around 80 million metric tons of global carryover. But you'll notice that that stocks to use number still hovers around 25%. So despite the fact that we've had successive record crops, you'll notice that that stocks to use number really hasn't moved to any kind of historical peak at this point in time. And the real reason for that is China. And as long as China's appetite doesn't weaken, the soybean market is going to stay fairly solid, but all of the growth is going to have to come out of China. It's really important for China to continue their expansion in demand. It's not going to be sufficient to say, well, we're going to take as much as we took as year before. Their exports are going to have to continue to grow beyond that 80 million metric ton level. They are not attempting to expand production on the soybean side. They're more than willing to import soybeans in a significant magnitude as long as they've got both the U.S. and South America as alternative suppliers. I think they're going to turn their attention to the grains complex in terms of the use of their acreage and continue to import. But again, the caveat here on the soybean market is that red line has got to keep moving higher to accommodate the kind of acreages we have in the U.S. and in South America. U.S. inventories of soybeans are going to build very substantially this year. We're probably talking about 450 million bushels. That's probably going to be the second or third largest inventory of soybeans. And again, that has put downward pressure on prices. But as long as China continues to be an aggressive buyer, that will stabilize the bottom side of the market at this point in time. But again, we're going to have to watch that one carefully. It'll have a lot to say about where our acreages go as we go forward in terms of moving further into the soybean complex or moving into the grains complex. Those are important issues for 2016 in terms of pricing, because as I've said before, I don't think the demand side is going to shift dramatically. It's really going to be a matter of where do we move these acreages as we go forward. You can see in all the commodity now, all of the commodities have experienced a downward movement in prices, 30 to 50% depending on the commodity that we're talking about. And again, we're beginning to kind of look at these levels. So when we look at corn prices, we see corn prices kind of stabilizing, around that 375 level. Wheat prices stabilizing around that $5 level. Beans in the 8 to 8.50 range, and cotton in that 60 cent range. So we are now in an environment, I think, for a lot of producers, every cent matters now. When we were getting $7 for corn, perhaps we're a little bit less aggressive in our marketing strategies now. I think all the producers are going to have to be much more aggressive with regard to marketing strategies and risk management, simply because the level of prices that we're talking about and the kind of input costs that lay behind them going forward. So a much different environment than we've been in over the last couple of years. And I think that transition is about complete, but it is a different period of time now in terms of marketing strategies. This slide gives you a little flavor of that. These are USDA prices from January. I don't think they're going to change these price projections very much based on the February numbers that they released today. But again, you can see this has a 2005-07 average prices for these commodities. In many cases, we're drifting back towards that average in terms of where we settle out. And I suspect that the commodity side on agriculture will do very much like the oil side. We may overcorrect on the downside for a short period of time and then begin to recover and find that kind of new normal zone that we're going to play in for a while, because we do have excess acreage that's moving around both domestically and globally. So we're going to have to wait and see what kind of transitions occur the next year. And I think that's one of the big keys in looking towards next year's crop in 2016. Where is this acreage going to go? We certainly have a fair amount of acreage that can move out of wheat, and will likely move out of wheat. We'll probably see more cotton produced. And then the question is, well, are we going to see more acreage in the soybean complex or the corn complex? That'll be a function, obviously, of these prices and these input costs as we go forward. But certainly a room to kind of move some excess capacity here, which I think in general will keep downward pressure on prices. I think we're not going to see much lower prices unless we see a collapse, particularly on the demand side in China. But at the same time, I think the upside opportunities are pretty limited given the acreage numbers that we have to move around, unless, again, Mother Nature kind of intervenes either domestically or internationally to give some adjustment on the supply side. When we look at the animal protein and dairy side, we're looking at larger meat supplies, continued strong U.S. demand, lower feed cost, but weaker exports. And I think that's kind of the combination that's out there. There's still good margin opportunities, not as attractive as they have been, obviously, as we begin to see these larger meat supplies. But I think in general, not a bad period of time going forward, but some challenges in terms of volatility. The big change, I think, particularly on the animal protein side, really has to do with the beef side. That cattle inventory declined very sharply up until this recent year due to drought, due to high feed costs and so forth. Now we're seeing some increases in the cattle inventory. I think we're making the turn now that we'll probably look at the first significant increase in beef production since 2006 in 2016. That dynamic is going to change the dynamic in the meat case. That shortage of beef supplies really had opened the meat case up for the pork and broiler side. Now I think we're with expanded beef production in 2016, we're going to see a different kind of pricing pattern. We're already seeing that in a number of the protein prices, despite the fact that I think the U.S. consumer, as alluded to earlier, is in pretty solid position, and a lot of these savings on the gas side are moving into the restaurant side, and I think that's been a positive thing. But we have a lot of adjustments that still have to be made in terms of going forward. When you look at total meat output, it's obviously up about 2 to 4% in 2016. You can see we were up in 2015 without much increase in beef production, but the reality is that we've really kind of increased meat production substantially over the last couple of years, and that really was a first increase in total meat production in 4 or 5 years. So the dynamics are changing in the meat complex in 2016, and that will be a more challenging environment. Feed costs, lower feed costs obviously are a partial offset to that, but certainly more risk management required, particularly on the pork side, where we had such a big surge in production in 2015, where we increased production by almost 7%. Now I think we're tempering that back going forward. The only other wild card in all of this, particularly for turkeys and eggs, is the avian influenza. The migratory patterns certainly will impact these industries again going forward. That's one that's going to have to be watch carefully, but we'll continue to see price volatility in both of those areas, I think, going forward. With regard to dairy, I think, again, we're still looking at increases in milk production. Prices have come off very dramatically over the last couple of years, but we still have some fairly large increases on the production side relative to demand gains, and I think that's going to keep downward pressure on prices. We have a lot of competition out there with weak global demand. The export markets really fell off very sharply in 2015, have not really recovered, and I think this is really kind of weighing on the market in terms of milk prices. Obviously, again, feed costs are a plus side for that, but I think the big challenge is we've simply seen a lot more expanded production, particularly in the European Union. If you look at the numbers over the last 5 years, U.S. milk production's up about 8%. European production's up 9%, with most of that coming in the last couple of years. So globally, I think we have more competition than ever, and again, the strong dollar weighs on our ability to match up with that increased production in other parts of the world. So again, these charts again reflect the same kind of adjustment. We're seeing the animal protein side. Those prices are beginning to adjust. They actually held up very well through 2014 into 2015, but now they've kind of come off as these larger meat supplies have weighed on the market, and these export markets have kind of stabilized a bit in terms of growth pattern relative to the production side. So I think that's what we're looking at now going forward. A little softness on the demand side. This slide is kind of USDA's estimates on these various commodities. You can see record prices across the board in 2014. Virtually every animal protein and dairy complex was looking at record prices. Now we're kind of transitioning back to a new reality. This is not inconsistent with agriculture. When we do get larger grain supplies and cheaper feed, we tend to see this expansion on the production side, and we've seen it again in 2015 into 2016. The softening of the global side really is just beginning to have its impact as we go into 2016. The only exceptions, again, if you look at this, is we're still looking at potential for strong prices on the turkey and egg side, as a lot of uncertainty with regard to the avian influenza, how it can play out in the future, but certainly a lot of volatility likely in those markets. Overall in agriculture, I think this chart just illustrates kind of the challenges that are out there. The crop side has made its adjustment now over the last year or so, over the last couple of years, in terms of transitioning to kind of a lower price level. Now we're watching the meats complex kind of come into line. A big spread between the crops and livestock side really wasn't sustainable. So we're seeing that realignment occurred, and now the big question is getting these cost pressures down. And again, I think the cost side of agriculture, particularly on the grains and oilseeds and cotton complex, we're going to see adjustments in input costs, fertilizer, chemicals. We've seen it in terms of absence machinery buying, but across the board, I think the cost side of agriculture is going to have to come back into line with these new realities in terms of acre returns. That's the transition I think we're going to see in 2016, but that always occurs with a bit of a lag in terms of the adjustment process. Net cash income in agriculture was extremely strong from 2010 to 2015, averaging 65% higher than the previous decade. But you can see now that in 2015, these income numbers have dropped fairly substantially. I think 2016, probably you'll see some stabilization of these income levels, but it does say that ag comes into this adjustment process with a lot of liquidity accumulated over the last 5 years. It means they're in a much better condition to kind of weather this storm as we transition from lower commodity prices into lower input costs, into a more stabilized return across the sectors. The balance sheet of agriculture is certainly much stronger than it was if you go back to the 70s, 80s experience. And again, you recall from that first slide, that run up in commodity prices in the early 70s really led to a debt-fueled asset increase through much of the late 70s into the early 80s. So when we get to the mid 80s, you can see a real difficult adjustment for agriculture as a result of that. We have not seen that debt-fueled drive on assets that we saw during that period of time in the more recent experience, and that suggests to me that the transition that we're about to go through will be much less dramatic than what we saw in the mid-'80s, but there will be areas where there'll be more pressure than others depending on how these commodity prices have evolved. This next slide just simply shows you cropland values and a weighted net returns per acre. So it really looks at the net returns per acre for the major commodities, kind of weights it up by the acres planted. And really it's not really designed necessarily to forecast where land values are going. It's really designed to show you the pressure that's out there in terms of land values and rental rates. And I think what we're going to see over the next few years is kind of a realignment of land values and rental rates in terms of new realities of the new zone that we're going to be operating in with regard to commodity prices. All of those adjustments are not going to be uniform across the country. If you look at what happened to land values from 2010 to 2015, U.S. land values went up 53%, but you can see across the country wide differences in terms of what happened to land values during that period of time. Some states like Georgia, South Carolina, really actually saw declines in land values. And many other states had very much more modest increases in land values. I think the real challenges are in these red and pink areas, where in some cases you've had the combination of energy because of fracking and horizontal drilling and agriculture driving land values. So I think those areas are probably more vulnerable to some adjustment on the land side. At the same time, I expect these transitions to be fairly slow going forward. There's a lot of liquidity in the farm sector. When land comes up for availability, there's a lot of liquidity in the sector to absorb some of that land, to limit some of the downside adjustment. But over time, we are going to have to realign the realities with the acreage return. So let me stop there, Tom. I think we've probably given the audience between the macro side and the ag side more than enough to chew on. So let's open it up for questions.
Great, thanks, Terry. That was excellent, and yeah, we do have a few questions in the queue. So thank you both, first of all. Yeah, so I think as I alluded to after Mike's presentation, wanted to go quickly back to China. And Mike, I'll start with you. The question had to do with what's going on in rural China, but I think it really gets to, I think, a point you made in terms of, what is the transparency, the confidence level in the kind of statistics that were coming out. And I guess I just asked for maybe expand on, have you both talk a little bit about that relative to the kind of the global economic impact as well as on the ag side when I turn it back to Terry. Mike, go ahead.
Sure. So there's not a whole lot of transparency in the Chinese statistics, frankly. But if you look at the consumption and the amount of power that's being used, and for people who visit the country, the kind of development patterns they've seen, there's been a tremendous amount of development in their cities and an urbanization that's been taking place over the last generation or so as people have moved from the rural areas into the cities. But I think that appears to be playing itself out. That is that there's evidence of overbuilding in some of these urban areas. Lots of huge public investments in infrastructure, lots of subsidized and strongly encouraged centrally investments in housing and residential development, and frankly, a lot of the international developments that you just heard about and I referred to earlier are affecting China as well. So that migration from the rural areas to the cities does appear to have slowed at the same time that kind of the world economy has slowed, and you've got a lot of overinvestments in these urban areas, and I think the rural areas continue to, in many parts of China, have a standard of living that's very similar to the one they had hundreds of years ago. So I do think that there's not a lot of transparency from my vantage point into the Chinese economy, but the development patterns, the way credit has been flowing, the way they've been making infrastructure investments, things that are visible, suggest that trend towards urbanization has at least temporarily slowed, and that they find themselves in the midst of a kind of a housing, commercial real estate, and credit market. Bubble, I think, is probably safe to say. That's my take.
Okay, good. And Terry, you touched on China as well in your presentation, a key market for certain commodities, especially a commodity like soybeans. Anything to add in terms of impact on
I think it's very difficult to kind of get a handle on China. What Chinese leadership is discovering is that markets are messy, and they can get in the way of political control and so forth. And I think we saw their response to the stock markets and so forth is to, well, geez, if the markets are going to collapse, we'll just stop everybody from trading, and try to dictate the purchases and so forth. So I think they don't have much experience with the markets. And I think they're kind of discovering that this is a lot messier than they thought it was going to be, and so they're quick to intervene. I think from the ag standpoint, the one thing to remember about China is food security is a kind of a #1 priority. So in all likelihood, you're not going to see any of this translate into big changes in their food security challenges. You saw that China acquires Syngenta. And that clearly is a move towards food security. They have big plans for their agriculture in terms of modernizing it and creating more of a factory-type system. They clearly have food security as a #1 agenda item in terms of maintaining political and economic control. So I think, we're going to talk, everybody talks a lot about China, but at the end, they continue to buy what they buy. They mess up with regard to trying to maintain internal prices above global prices. I think they're changing their policies now. They're moving towards, we're going to make direct payments to producers as opposed to trying to artificially elevate domestic prices, which penalize their processing industry. So they're learning a little bit about, how messy these markets are going to be, and they're learning how to kind of maneuver through them. So I think it's a learning exercise for them. Some things are getting right, some things are not. I think for agriculture, it's still a big market. It's still the key market, I think, in terms of growth. Until we can get India opened up as an export market, we really do have to ride the wave of that 1.5 billion people sitting in China.
Okay, great. Question came in. I'm going to direct this one to Mike. So there are a number of states who proposed increases in the minimum wage. New York has a proposal on the table to go from $9 to $15 an hour. I believe Massachusetts is in the middle of a more modest increase in minimum wage. What kind of impact does this have on the job market and industry competitiveness?
Right, so that's a big question. But so from the vantage point here in Massachusetts, we haven't seen really any negative impact as of yet. So we've moved from $9 an hour, which was I think from 8 to 9, and then recently to 10, and scheduled next January moved from $10 to $11 an hour. And as of yet, we haven't seen any real negative impact on our job growth here, which has continued substantially. Significantly, I think we're demographically in a position where we rely fairly heavily on immigration from other states and from other parts of the world, and so and we're on the leading edge of that demographic transition I referred to earlier with the aging population, and so we don't have labor supply issues. So where I would expect you might see negative effects from efforts to raise the minimum wage would be in places where there are where you have excess labor capacity. So I do think that the literature on this, the research literature on this, is moving in a direction, I think, to suggest that the standard take on the implications of a minimum wage increase is a little more is not accurate, that it necessarily reduces the rate of job growth. We've had very stagnant wages in the United States at the low end of the labor market for a long time, and so the best work I've seen recently suggests that efforts to move the minimum wage to $15 an hour may kind of get to a point where that exceeds the cost of that kind of a policy in terms of reduced job growth and associated impacts may exceed the benefits. But the best work I've seen suggests that if you're sensitive to regional cost of living standards, that somewhere around half of the median income as an hourly wage is a reasonable point beneath which, where you can feel pretty comfortable that the economic costs writ large will be exceeded by the benefits. Here in Massachusetts, that implies a $13 to $14 an hour minimum wage. In other areas of the country where living costs are lower, it would suggest lower, and obviously there are higher cost of living areas as well. So I don't see that as an imminent threat. It's clearly something, at least based on today's political environment, is going to be taken up at the state rather than the federal level, at least in the near term. But it's not anything that I'm particularly concerned about at this stage.
Okay, thanks. So we're at 1:30. We got one more question in here I want to hit for Terry, having to do with dairy. Dairy is a big commodity here in the Northeast. So sort of a two-part question. One is, what are the destination countries? You mentioned the importance of exports for EU, and I guess it sounds like we're competing with them in certain cases there. And if you have a feel for, with the dramatic decline in prices from 2014, kind of a flat forecast for 2016, do you see, what are you seeing in terms of a bottom for dairy prices? So Terry, why don't I let you tackle those?
Well, I think we're kind of getting to that bottom. I think the demand side is kind of really the driver at this point in time. I think if you remember that slide that I had up there in terms of our markets, obviously Mexico and Canada have been kind of steady markets for us for some time, but the next market is China, Japan, Philippines, Indonesia, South Korea. So it's really about these Asian markets as much as anything else, and whether we've got the right products. I mean, we do need to move out of the skim side and develop more products customized for this part of the world and so forth. So I think in reality, we've seen most of the currency adjustment we're probably going to see. And now I think it's a matter of these economies beginning to grow again. So I really think that we're probably looking at the bottoms at this point in time, that as we move forward, we're going to see the demand kind of stabilize. We need to take this volatility out of the market that's sitting there. Oil and China have kind of dominated everything in terms of everybody's expectations, I think. As we get into the second half of this year, I look for some improvement in terms of the demand side beginning to pick up a little bit. I think the U.S. side will also see some improvement. So I'm kind of optimistic moving forward that we're going to see some steady increases. Are we going back to $25 milk? No, I'm not sure we're going to get there very fast. But I think we're kind of looking at the bottoms now, and we'll see the demand side begin to carry us forward as we go further into 2016, into 2017.
Okay, well, great. Well, we're a little past our stopping time. I again want to thank you both for your presentations. Some great discussion, great information about the general economy and the outlook for U.S. agriculture. On the cover slide that's being shown right now, you can see that we do archive our webinar recordings. That includes the slide deck for viewing at farmcrediteast.com/webinars. So this webinar will also be posted there along with some of our recent webinars. So with that, thanks everyone for attending today, and we'll look forward to seeing you for the next webinar.